The fintech industry is still young and has grown at an exceptional speed. This has placed pressure on financial regulators around the world to understand these new technologies and how they fit within the current regulatory framework. In this lecture, we'll look at the challenges regulators face in adjusting to new technologies that are primarily being introduced from firms that are currently outside the regulatory perimeter, and how several U.S. regulatory agencies are responding to fintech innovation. The pace of technological change necessitates a rethinking of current regulatory structures. These structures are largely premised on a model of banking that preceded the digital revolution, when you conducted your banking at your local branch and balanced your checkbook every week. Regulations built for this model of banking are simply not conducive to fostering and promoting new innovations in financial services. But how should regulators respond? Well, that depends on the jurisdiction. There are a variety of financial ecosystems around the world, all with varying degrees of complexity in regulatory frameworks. Given this diversity, there is not going to be a one-size-fits-all approach that will work in every country or satisfy all stakeholders in each country. Different regulatory agencies may also have different mentalities when it comes to innovation, and these mentalities will play a large role in how they respond to fintech. In some countries, like the UK for instance, regulators are tasked with promoting competition, and these regulators may view fintech firms as being better situated to meet the needs of market segments that are not currently being served by traditional banks. Many regulatory agencies also recognize that technology is and will remain a part of life, and if that consumers are utilizing financial services in new and innovative ways, it is incumbent upon them to adjust and accommodate these new technologies. Regulatory agencies are also responding on the basis of inquiries from industry stakeholders. Many new fintech firms have begun asking how they are regulated, placing the regulator in the position of having to determine what adjustments in current frameworks are needed, if any, to accommodate the various changes occurring in the business operations and models within the financial services space. Complicating the U.S. response to fintech is our fragmented regulatory system, with fintech activity often being supervised by 2 or more regulatory agencies. Each of these agencies has a different statutory mandate and internal culture, and may not see eye to eye on many issues, including fintech. You will learn more about the various agencies responsible for regulating different fintech sectors later on in this course. Absent a comprehensive national fintech strategy, several U.S. federal regulatory agencies have adopted their own initiatives that are primarily designed to facilitate communication between fintech innovators and financial regulators. For instance, the Consumer Financial Protection Bureau, or CFPB, has launched Project Catalyst, which is an initiative to encourage consumer-friendly developments for consumer financial products and services. Through Project Catalyst, the CFPB has launched several research collaborations with companies that are testing financial products or services. Through these projects, the CFPB gains insight into how consumers make financial decisions and improve their understanding of new consumer-friendly innovations in the marketplace. According to the CFPB, as of August 2017, they had met with approximately 150 companies in 4 Project Catalyst events in New York and San Francisco. The Commodity Futures Trading Commission launched Lab CFTC to be the hub for the agency's engagement with the fintech innovation community. It is designed to make the CFTC more accessible to fintech innovators and serve as a platform to inform the Commission's understanding of new technologies. Lab CFTC's core components include GuidePoint, a dedicated point of contact for fintech innovators to engage with the CFTC, learn about the CFTC's regulatory framework, and obtain feedback and information on the implementation of innovative technology ideas for the market, and CFTC 2.0, a program to foster and help initiate the adoption of new technology within the CFTC's own mission activities through collaboration with fintech industry and CFTC market participants. The Office of the Comptroller of the Currency, or OCC, launched the Office of Innovation to be the central contact and clearinghouse for requests and information relating to innovation in the federal banking system. The Office of Innovation has 4 core components. Number 1, outreach and technical assistance to establish open and continuing dialogue with banks, financial technology companies, and other non-bank parties and technical assistance. 2, coordination and facilitation to implement a process to streamline and coordinate innovation-related decisions to ensure transparent and timely responses to inquiries. 3, awareness and training that improves the skills and knowledge of OCC staff, and 4, research that assesses the landscape and trends in financial innovation. If you are unfamiliar with these agencies, don't worry. You will learn more about them in the modules to come. In addition to launching their own initiatives, U.S. regulatory agencies have also opened new channels to share information with one another in an effort to provide a more coordinated response to fintech innovations. For example, in 2010, the Federal Reserve Banks of Atlanta and Boston created the Mobile Payments Industry Working Group to facilitate discussions among industry stakeholders about how a successful mobile payment system could evolve in the United States. This group also functions as an interagency collaboration mechanism through biannual meetings between industry stakeholders and relevant regulators. In 2016, the Treasury Department created the Interagency Working Group on Marketplace Lending, which met 3 times over the course of fiscal year 2016. The purpose of the working group was to share information, engage industry participants and public interest groups, and evaluate where additional regulatory clarity could protect borrowers and investors. In March of 2017, the Federal Reserve convened the Interagency Fintech Discussion Forum, which is an informal group that meets approximately every 4 to 6 weeks and aims to facilitate information sharing among consumer compliance staff from the federal banking regulators on fintech consumer protection issues and supervisory outcomes. Discussion topics have included account aggregation, alternative data, modeling techniques, as well as third-party oversight. In addition to these domestic interagency working groups, there are a number of fintech collaboration efforts between regulators from different countries. Sharing information across regulatory agencies, both domestic and foreign, allows regulators to stay abreast of the latest fintech developments and can promote a common understanding and consistent application of laws and regulations.